Hello and welcome back to the channel. In today's video, we are diving into the banking sector to understand some interesting financials and performance metrics. Specifically, we'll take a closer look at important ratios related to banks and consider a set of ratios as an example to learn what they reveal about any bank's financial health. But that's not all. We'll also do a quick peer review with other major players like Kotak Bank, Axis Bank, HDFC Bank, and ICICI Bank using data from Screener. These banks have been selected randomly, and there's no particular reason for their inclusion. It's simply to provide a broader view of the banking sector. So, let's get started. Firstly, let's take a closer look at this Screener page for Kotak Mahindra Bank. One thing you might notice right away is that the debt of 5,20,374 crore rupees is much higher than the market cap. Now, at first glance, this might seem like a red flag. After all, in most industries, having more debt than market value is often a sign of financial stress. However, it's important to remember that banks operate under a different business model. In the banking sector, debt is not necessarily a bad thing. In fact, banks are expected to have a high debt figure because they function by borrowing deposits from customers and then lending that money to borrowers at a higher interest rate. So, instead of panicking when you see debt greater than market cap for a bank, it's important to look at other financial metrics. What matters more in banks is how efficiently they manage their debt, whether they can generate profits and cover their interest costs, how their loan portfolio is performing, and how solid their balance sheet is. For example, Kotak Mahindra Bank has a debt-to-equity ratio of 4.00, which tells us the relationship between its debt and shareholders' equity. While this seems high, it's typical in the banking industry because banks leverage their debt to increase profits. Banks use borrowed money, mostly deposits from customers, to make more money. Here's how it works in simple terms. Imagine you are running a lemonade stand. You don't have enough money to buy lemons, sugar, and cups. So, you ask your friends to give you some money. You promise to pay them back later, but for now, you are using their money to buy supplies. Now, you make lemonade and sell it to customers for more money than what you borrowed. The extra money you make is your profit. After paying back your friends, you still have some money left for yourself. So, banks use the money they owe to people to make more money, just like you use your friends' money to sell lemonade and earn a profit. Even if you look at the peer comparison, an interesting observation is that all the major banks have much higher debt than their market capitalization. For instance, HDFC Bank has a debt of 31 lakh rupees crore, ICICI Bank stands at 16.5 lakh rupees crore, and Axis Bank at 12.9 lakh rupees crore. What does this tell us? Well, unlike other industries, having debt that exceeds the market cap is pretty common in the banking sector. So, don't be alarmed by this, it's a standard part of how banks operate. So, what are the key ratios or KPIs to consider when analyzing the banking sector? Instead of the usual metrics, there are specific financial ratios that offer deeper insights into the performance and stability of banks. On the screen, you can see some of the key ratios to focus on when assessing their financial health. These include Capital Adequacy Ratio, Net Interest Margin, Non-Performing Assets Ratio, Provision Coverage Ratio, Return on Assets, Return on Equity, Gross NPAs versus Net NPAs, CASA Ratio, and CET-I, that is Common Equity Tier 1. Now, let's dive into a specimen bank example to better understand these ratios in action. First up, Capital Adequacy Ratio is at 22.7% for June 2024, slightly down from 23.2% last year. This ratio shows how well capitalized the bank is, and anything above 15% is generally considered strong. A healthy CAR means the bank has enough capital to cover potential losses, making it less risky. Next is CET-I, that is, Common Equity Tier 1 ratio, at 21.8% in June 2024, which is also down from 22.2%. CET-I is a stricter measure of the bank's core capital. Ideally, a CET-I above 10% is good, showing the bank has a solid financial cushion to withstand any economic shocks. Moving on to ROA, return on assets, which has risen to 3.88% in Q1 FY25 from 2.62% a year ago. This ratio tells us how efficiently the bank uses its assets to generate profit. Anything above 1.5% is considered strong in banking, so this is a great improvement and signals efficient performance. Return on equity is another important one. At 22.03% in Q1 FY25, up significantly from 14.63% last year. Return on equity measures how well the bank is generating returns on shareholders' investments. A good return on equity for banks is above 12%, so this is an excellent indicator for investors. Net non-performing assets, a critical measure of asset quality, is down to 0.36% in June 2024 from 0.41%. Lower NPAs are a good sign because they indicate fewer bad loans. Anything under 1% is considered very healthy for a bank. Next is the CASA ratio. This has dropped to 43.2% from 48.0%. CASA measures the proportion of deposits in current and savings accounts, which is cheaper for the bank compared to fixed deposits. A higher CASA ratio, ideally above 40%, shows the bank has a cheaper source of funds, helping improve profitability. Net interest margin is at 5.03% for Q1 FY25, slightly lower than 5.55% last year. NIM shows the profitability of the bank's lending activities. Generally, a NIM above 3% is considered strong, so this figure indicates the bank is still earning a healthy return on its loans, though the slight dip is worth noting. Lastly, provision coverage ratio is at 74% in June 2024, compared to 77% last year. PCR shows how much of the bank's bad loans are covered by provisions. A ratio above 70% is a good sign because it means the bank has adequately provisioned for potential losses. In summary, this specimen bank has a strong overall performance. The slight dips in CASA and NIM are worth monitoring, but overall, the bank's financial health looks solid, providing confidence for investors. Here's a brief table explaining the importance and good values of the listed key ratios for understanding the financial health of banks just at a glance. Any significant deviations from these good values can be seen as red flags for investors, signaling a potential problem in the bank's operations or loan management. Now let's take a look at the credit and deposit growth for banks. They are key indicators of a bank's overall performance and its ability to serve customers. Investors look at credit and deposit growth in a bank because it helps them understand how well the bank is doing. Credit growth shows how much money the bank is lending out. If it's lending a lot, it means people trust the bank and want to borrow money. Deposit growth shows how much money people are saving in the bank. A lot of deposits mean people trust the bank to keep their money safe. For investors, a healthy balance between credit and deposit growth suggests good liquidity management. Imagine a bank as a big piggy bank where people put their money to keep it safe. The money people put in is called deposits. The bank then uses some of this money to give loans to people who need it. When the bank gives more loans, it's called credit growth. Deposit growth means more people are adding their money to the bank. Take a look at this bar chart. Bank named A has a big jump in both the money it lends out and the money people save with it. Bank A's lending went up by 26.1% and its savings by 31.6%. Meanwhile, Bank B also saw more lending, but not as much, with 18.5% credit growth and 10.21% deposit growth. For investors, this means Bank A is giving out more loans and also attracting more savings, which could mean it's growing faster and could earn more profit. Bank B is growing too, but at a slower rate, so investors might think it's a little less exciting right now compared to Bank A. Thank you for watching our breakdown of key banking sector ratios. If you found this video helpful, don't forget to like, share, and subscribe for more financial insights. Stay tuned and see you in the next one.